Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings, and let's just say this latest one from Citigroup Inc. has some interesting layers of debt instruments. We're diving into a Form 8K, a current report that often signals significant events for a company. For Citigroup, this one is all about their debt and how they are managing it. It's not the usual profit and loss story you might expect, but rather a look at their financial architecture. Before we jump in, if you like getting these straightforward breakdowns of complex financial documents, make sure you're subscribed and hit that notification bell. Also, join our thriving Discord community linked in the description below for more in-depth discussions. This report is primarily detailing several new indentures, which are essentially legal agreements for issuing debt. Think of them like contracts for borrowing money. Citigroup has entered into multiple new ones, all dated the 9th of January 2026. These are not minor adjustments, they are significant additions to how the company finances itself. We're seeing supplemental indentures to existing indentures, meaning they are modifying or adding terms to previous agreements. One of the key documents here is the 8th supplemental indenture. This is an update to a very old original indenture from 1987. What's fascinating is that they are still amending agreements that are decades old. This indicates a long-standing and evolving debt program. The Bank of New York Mellon is acting as the trustee, which means they are the intermediary between Citigroup and the bondholders, ensuring HPL to the agreement. We also see a 5th supplemental indenture related to an indenture from 1996. Again, these are amendments to establish debt frameworks. It's important to understand that these indentures define the terms of debt, like interest rates, maturity dates, and covenants. Every time Citigroup issues new debt or modifies existing debt, these agreements are central. The report lists a 12th supplemental indenture, referencing an original indenture from 2004. The numbering here shows a consistent pattern of Citigroup building upon its debt issuance over many years and across different types of debt. There is also a 4th supplemental indenture related to an agreement from 2016. This one specifically names Citigroup Global Markets Holdings Incorporated alongside Citigroup Incorporated, suggesting this debt might be issued through a subsidiary. This is common for large financial institutions to manage risk and operations. The filings also give us a glimpse into the specific types of debt being managed. We see references to things like Series N medium-term senior notes due April 2028. This tells us Citigroup is issuing medium-term notes, which are a common way for companies to raise capital in the debt markets. These notes have a fixed maturity date, in this case 2028. There are also Series N medium-term senior notes due September 2026. The dates are crucial. Companies manage their debt maturity profiles to ensure they have access to cash when obligations come due. Aligning these dates with their business cycles and access to financing is a key part of financial strategy. And more Series N medium-term senior notes, this time due September 2028. The repetition of Series N suggests a particular class or series of notes that Citigroup is actively managing and potentially issuing more of. We also have Series N medium-term senior notes due October 2028. The sheer volume of these notes with slightly different maturity dates highlights how Citigroup is continuously layering its debt to manage its overall financial structure and cash flow needs. Finally, Series N medium-term senior notes due March 2029. These are all senior notes, meaning that in case of bankruptcy, bondholders of these notes would have a higher claim on assets than subordinated debt holders. While this filing doesn't contain detailed financial statements like a 10Q or 10K, the mention of securities registered under Section 12B of the Exchange Act is significant. It means these securities are traded on a national securities exchange like the Nasdaq or the New York Stock Exchange, making them accessible to a wide range of investors. Exhibit 99.1 likely lists these specific securities, giving us a broader picture of Citigroup's publicly traded debt instruments. Now, let's talk about what this all means. Citigroup is a massive global financial institution. Their business is inherently tied to managing vast amounts of debt and capital. These new indentures and the continuous amendment of old ones show a company that is actively managing its capital structure. They are likely issuing new debt or modifying terms of existing debt to fund operations, manage interest rate risk, or perhaps to refinance older debt that might have higher interest rates. From a Warren Buffett perspective, we want to see a company that has a clear and understandable business model, pays down its debt, and generates consistent cash flow. While this 8K doesn't give us cash flow numbers, it does show active management of their financing. The fact that they are dealing with decades-old indentures suggests a conservative approach to long-term financing, but also a need to adapt as financial markets evolve. Are there risks? Of course. When a company has a lot of debt, it is more vulnerable to economic downturns. If interest rates rise sharply, their borrowing costs can increase, impacting profitability. Also, complex debt structures can sometimes mask underlying issues, although Citigroup's scale and regulatory oversight usually mitigate this significantly. The key thing to watch is the overall debt level relative to their earnings power and the interest rates they are paying. Without specific figures on the amount of debt issued or their interest expenses in this particular filing, it's hard to give a precise financial health assessment. However, this report confirms that debt is a central and continuously managed pillar of Citigroup's financial strategy. In conclusion, this 8K filing is purely about debt issuance and management. It points to a company that is actively shaping its financial landscape by entering into new debt agreements and updating old ones. It's A behind the scenes look at how a financial giant funds itself. It doesn't reveal immediate profit or loss, but rather the plumbing that keeps the financial engine running. The significant number of supplemental indentures points to ongoing financial operations and a dynamic approach to debt. Alright? That's our breakdown of Citigroup's latest filing. What's your take on these debt-focused updates and what they signal for the company's future? Are you comfortable with large financial institutions constantly managing such complex debt structures? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord link in the description. We have some great conversations happening there. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.